Good afternoon, everybody, and welcome to our June Bank Council Roundtable. In past years, we have not done these during the summer, but this year, in light of all of the important developments going on in the banking world and the fact that there's no baseball for us to take you guys to, we're going to continue the roundtables over the summer. Today's program is 60 minutes. And the materials and attendance form are available from events@dorsey.com. The biographies of the three presenters are at the end of the materials, and you should feel free to reach out to any of them or to your regular Dorsey contact if you have any questions. Let me introduce the three panelists. Matt DeArman is a partner in our finance and restructuring group in Dallas. He has represented administrative agents, lenders, and E&P companies in closing and restructuring reserve-based lending facilities throughout his career. Joe Acosta is also a partner in the F&R group in Dallas. He has represented E&P companies and lenders inside and outside of bankruptcy in distressed situations. He's currently working on a couple of oil and gas bankruptcy cases in Dallas right now. Finally, Mark Burghardt. Mark is a partner in our regulatory affairs practice group in Salt Lake City and is the chair of our oil and gas industry group. He has spent his entire career helping oil and gas E&P companies obtain, develop, and divest oil and gas assets throughout the United States. So without further ado, I will turn this over to the panel.
Thanks, Tom. Hello, everyone. We hope you and your loved ones are healthy and safe. Thanks for joining us for a very timely discussion on issues related to the upstream oil and gas industry, and specifically issues important to lenders in that space. First, an overview of how we ended up where we are. Next slide, please. The price of oil and gas drives the industry, and since the beginning of 2020, oil prices have taken a dive, even briefly falling into negative numbers for the first time since prices have been recorded. The precipitous fall in oil prices we've seen this year can be primarily pinned on the twin disasters of the increase in output due to a price war that began in March when the OPEC countries and Russia ended a pact that had propped up commodity prices for 3 years when Russia refused to cut production. That led to the Saudis flooding the market. And of course, the COVID-19 pandemic and its resulting drop in demand due to the shutdown in travel and the slowing of the world economy generally. While the first half of 2020 has been particularly bad from a price perspective, and looking at the charts on this slide, the prices of crude oil and natural gas have been on a downward trend for years, with crude now hovering around the $35 to $40 per barrel mark. Natural gas has been sitting firmly at rock bottom prices due to the warm weather and a glut of production. This downward trend has been making life difficult for E&P companies since long before anyone had heard of the coronavirus. And the result in 2019 was bankruptcy filings by 42 E&P companies as compared to 28 in 2008. Next slide. It's unclear when or if oil and gas prices will rise again to profitable numbers. The decline in demand due to the COVID-19 pandemic is really unprecedented, and it's unclear how soon the pandemic will wane or if reopening efforts for the fall and winter seasons will wipe out any gains in reducing the impacts of the virus. Even if the pandemic does ease, it's unclear how far-reaching its effects will be on the future of commodity prices. The new normal of working remotely and relying on more local supply chains may turn out to be a more permanent situation, extending the lack of demand for oil for the long term. The chart on this slide shows the results of a survey of E&P company executives taken by the Federal Reserve Bank of Dallas last month. The chart shows that over 60% of the oil and gas executives surveyed believe that the price of crude oil will be less than $45 per barrel at the end of 2020. So while no one knows how long this will last, all signs point to an extended period of lower oil and gas prices. Next slide. Finally, and most important to this discussion, what is the result? The charts you see here were taken from the Dallas Fed survey last month and show crude oil prices necessary in order for E&P companies to profitably drill new wells and prices necessary in order to provide sufficient cash flow to cover operating expenses and organized by location. The charts show that on average, the oil and gas companies surveyed need $49 per barrel to profitably drill and $30 per barrel to cover operating expenses, with many needing significantly more depending upon the location they're operating. Based on these charts, none of the E&P companies surveyed can profitably drill a new well in the current price environment. And for much of 2020, most of the companies surveyed have been unable to cover expenses through operating cash flow. When coupled with the price forecast in the previous slide, almost none of the executives surveyed expect to be operating profitably, at least through the end of 2020. As evidenced by the amount of bankruptcy filings in 2019, in an environment where oil prices hover around $60 per barrel, E&P companies have been operating on razor-thin margins for years. When the general downturn curve is combined with all of the unforeseen events of 2020, creating additional downward pressure on commodity prices, the outlook for E&P companies and the industry as a whole is negative for both the short and long term. Of course, adding to the stress factors these companies are struggling to manage is the fact that many E&P companies started 2020 flush with debt after tapping their lines to drill new wells and increase production over recent years. E&P companies who have already filed for bankruptcy this year had a combined debt of around $10.5 billion when they entered bankruptcy. Many of the companies who are struggling now have had no availability under the reserve-based credit lines as they were already maxed out prior to the beginning of the price war pandemic. In short, this is a dire situation for many E&P companies, and many of them are currently insolvent as a result. Based on responses to the Dallas Fed survey last month, even if the price of crude rebounds and stays around $40 per barrel, 40% of the executives surveyed said they expect their company to be insolvent within 2 years, with 15% expecting to be insolvent in less than a year. The new normal may be an environment in which many middle to lower market E&P companies just can't survive. Next slide. Many E&P companies and most oil and gas lenders have operated in a very difficult price environment before, but the current environment seems worse and more likely to be long-lasting. So many companies and their lenders are trying to find a way out of the box. For lenders to E&P companies, the three general options are restructure the loan terms or enter into a forbearance agreement in the hopes that prices increase, or take some other steps outside of court, short of exercising remedies, to push through to recovery. Number two, restructure or liquidate in a proceeding controlled by a court through voluntary or involuntary bankruptcy. Or number three, become the owner and operator of the borrower's properties, either through foreclosure or by accepting the properties in satisfaction of some or all of the debt. I'll be discussing lender considerations under option one, and my colleagues will discuss considerations related to options 2 and 3. Next slide. To frame our discussion, I want to give a quick description of a reserve-based loan, or RBL, facility term. A typical RBL facility is a revolving loan facility that includes a borrowing base. It limits the amount of the loans that can be borrowed under the facility. The borrowing base is typically redetermined twice each year, once in the spring or summer and once in the fall or winter, based on reserve reports delivered by the borrower that provide an evaluation of the oil and gas reserves of the loan. The lenders take the reserve report provided by the borrower and apply their own price deck to the report in order to determine the assumed future price of oil and gas production. After taking into account many other factors, such as weighting for different categories of properties, commodity hedging, and cost assumptions, and applying an advance rate, the lender or group of lenders redetermines the borrowing base, setting availability into the line for the next 6 months. Borrowing base redeterminations are more of an art than a science, and each lender typically weighs different factors differently from other lenders. Each lender also produces its own price deck based on many factors. With syndicated RBL facilities, the administrative agent suggests a new borrowing base, and the other lenders typically vote, with an increase in the borrowing base requiring the affirmative vote of all lenders, and the maintenance or lowering of the borrowing base only requiring the consent of a portion of them. The facility is typically secured by a first lien on some percentage, typically 80 to 90%, of the oil and gas reserves in the ground included in the most recent reserve report delivered by the borrower, by filing of mortgages and deeds of trust in the counties where the properties are located. Because interest in oil and gas properties are specialized and in most states a type of leasehold interest, title companies don't confirm or insure title, but rather title attorneys or contract landmen obtain and review title documents in order to confirm ownership of the interest. RBL facilities typically include financial covenants tested quarterly, with maximum leverage covenants being the most common. Failure by the loan parties to maintain financial covenants is, in many cases, the default that brings the parties back to the table, so lenders can work with the borrower on developing a path forward before the situation becomes untenable. Most RBL facilities include a requirement that the loan parties execute commodity hedges on some percentage of their oil and gas production and to maintain such hedges on a rolling 12 to 24-month basis in order to hedge against commodity price volatility. These hedges are required in order to provide some level of certainty about the borrower's cash flow and are considered by lenders in setting borrowing bases. Many E&P companies hedge a greater percentage of production than required in the credit agreement, with most credit agreements also setting maximum percentage. The most typical type of hedging used by E&P companies is arguably the swap, which sets a fixed price for which a company can sell its oil and gas. Typically, an RBL facility will permit the sale of a certain percentage of oil and gas properties included in the most recent reserve report, normally around 5%, between borrowing base redeterminations without requiring a paydown of loans. In a low or very volatile price environment like we're experiencing this year, a borrowing base redetermination can be painful for all the parties involved. In the last 6 months, many lenders have reduced their price decks by half or more. When the spring borrowing base redetermination arrived, many lenders faced the difficult prospect of potentially putting their borrowers into bankruptcy by slashing borrowing bases in half. If the facility was already maxed out, or in other words, if the amount of the loans outstanding was equal to the prior borrowing base, a massive reduction in the borrowing base would require the borrower to either prepay the resulting borrowing base deficiency, which could be a massive amount, or provide mortgages covering additional properties to fill the gap, which many borrowers didn't have. The result in some cases would be a bankruptcy filing or foreclosure. Most lenders want to avoid these scenarios. Next slide. For many lenders, the initial line of defense is to determine if there is some way to avoid slashing the borrowing base to a level below the amount of the principal outstanding on the facility, in the hope that the next scheduled borrowing base redetermination would occur in a better price environment. During the most recent extreme drop in commodity prices in 2014, many lenders simply skipped the spring borrowing base redetermination. Others looked to mitigating factors as reason to determine a higher value than the drop in prices would otherwise have dictated. This is called a borrowing base stretch. In the Office of the Comptroller of the Currency's Handbook on E&P Company Reserve-Based Lending, the OCC states that lender approval of a stretch should be supported by documented risk mitigants, and that the approval of a stretch borrowing base should not be used to avoid borrower repayment requirements caused by an overadvance. However, the handbook also lists methods by which you can stretch a borrowing base and related mitigating factors, including providing higher advance rates, allowing less conservative risk factors, and increasing the value attributable to the properties that are not producing. Other stretch methods include allowing leasehold value when the borrower's acreage position is located in a particularly competitive area, lending beyond 100% on producing properties on a temporary basis with interest rates and fees that reflect the increased risk, giving value for the next 6 months' production, which is usually omitted from the borrowing base or the month of production, and lowering the discount rate for determining the net present value of reserves, thereby increasing the total present value. Many of these methods of stretching the borrowing base were used by lenders in the last big price crash in 2014, and it's expected that the OCC examiners will be tougher on lenders who use these methods to stretch in order to avoid borrowing base deficiencies. In any case, continuing to stretch beyond the fall redetermination may be difficult or impossible for lenders to justify. If the borrowing base is stretched, lenders should consider requiring that the credit agreement be amended to provide automatic borrowing base on repayment during the period from the stretch redetermination until the next scheduled redetermination. In effect, this causes the outstanding amount of the facility to be treated as a term loan rather than a revolving loan until the next redetermination occurs by reducing the borrowing base with each payment rather than such payments resulting in additional borrowing availability. Many lenders also implement a monthly excess cash flow sweep during this period as a mechanism to further reduce the borrowing base in the event of excess cash in the company. Another option for lenders is to restructure the credit agreement to allow for a conforming and non-conforming borrowing base with higher interest charge on the non-conforming portion. Similarly, the borrowing base deficiency resulting from a redetermination can be restructured as a term loan with separate pricing and payment terms. Many RBL credit facilities have this option hardwired into the credit agreement, providing for an increased interest rate and amortization over a period of time for the deficiency term loan. Another helpful option that may be available to lenders is to permit borrowers who are properly hedged to liquidate, which are now in the money due to price drops, and to use the proceeds to pay down the principal outstanding on the facility, reducing the borrowing base by the amount of the pay down. This amounts to trading long-term volatility control for a current reduction in outstanding. However, there are other hedging products such as collars that may make more sense in a low price environment, and borrowers may be better served by replacing in-the-money swaps with such products in any case. In this environment, most borrowers will need some relief on financial covenants in order to avoid an immediate default as of the end of the next fiscal quarter. If the goal is to push through to the next redetermination of the borrowing base, and hopefully until prices increase, providing such relief may make sense. Other changes to the RBL facility the lender should consider include requiring 100% of all properties and loan parties to be encumbered by liens in favor of the lenders, instituting tighter covenants regarding reporting, such as weekly reports of well shut-ins, caps on costs and expenses and non-maintenance capital expenditures, increased controls on property sales, and elimination of the ability to pay dividends or maintenance charges. Next slide. For some borrowers, the squeeze caused by the price drop is just the latest problem. Many came into 2020 already in default of fourth quarter 2019 financial covenant. For many lenders, the drop in value is an opportunity to force the borrower to find a solution to an already difficult situation, one in which the lenders have lost faith in management's ability to guide the company to a successful repayment of the facility. In such cases, the best route may be to require the borrower to stay in default and enter into a forbearance agreement. Under a forbearance agreement, the lenders agree to forbear from exercising remedies that are available to them for some period of time in order to give the borrower an opportunity to take action to increase the recovery of lenders, such as through selling properties for the repayment of the outstanding debt or finding another group of lenders to refinance the facility. Any events of default remain outstanding, and as soon as the forbearance period ends, the lenders will have the right to accelerate and begin foreclosure on the collateral if necessary. For distressed companies, the sale of assets may not ultimately help the company deal with a borrowing base deficiency due to the fact that the borrowing base already reflects what should be close to the market value of the company's assets. Upon a sale of assets, the debt is repaid with the proceeds, and the borrowing base is reduced by the amount repaid, but the overall value of the assets supporting the borrowing base is also reduced. Assuming all of the borrower's assets are included in the borrowing base, in theory, the sale of all such assets should not result in repayment of all of the debt outstanding. However, many lenders are happy to receive a paydown that is ultimately less than 100% of the debt, but much greater than the expected recovery in a bankruptcy scenario. Other potential goals to increase recovery by lenders during a forbearance period are the sale of the company as a whole, the issuance by the company of additional secured debt that is subordinate to the RBL facility. However, finding a lender to provide subordinated debt will be very difficult under current situations. Solicit investments in the company by private equity firms. Again, with such investments being very difficult to obtain on acceptable terms, not only due to the pricing environment, but also due to the fact that private equity firms are increasingly concerned with the impact of investing in companies that may be perceived as environmentally irresponsible, or an exchange of debt under the facility for equity in the company. The initial determination under any forbearance agreement is how long should the forbearance period be. Before making this decision, the lender group should have counsel perform a collateral review to confirm that the security documents encumber the expected collateral and that the liens are properly perfected. If there are defects in the collateral package, this will be the time to remedy those defects. And in order to avoid a preference action in what may be a pending bankruptcy that would seek to invalidate any liens, the forbearance period may need to be set for at least 90 days to allow the preference period to run before the borrower is forced to take action. To the extent no defects in the collateral package are discovered, it may make sense to set a shorter forbearance period to put pressure on the borrower in order to speed up the process. Other typical features of forbearance agreement include an increase in the interest rates charged during the forbearance period, a freeze on the making of any new loans under the facility, milestones regarding recovery efforts, such as dates for the receipts of letters of intent or term sheets, and definitive documentation regarding the sale of assets or steps toward refinancing. A requirement that the equity owners of the company make an equity contribution so that the owners share in the risks associated with the a requirement that the borrower hire and retain financial advisors or a chief restructuring, enhanced financial reporting, a minimum liquidity covenant, a release of all claims against the lenders arising in connection with the facility. In the event the borrower violates any of the terms of the forbearance agreement or any additional events of default occur under the loan documents, the forbearance period automatically ends and the lenders are free. To the extent the borrower exhausts all of the options discussed above, and it looks like the forbearance period will end by placing all parties back in the same situation or worse that they were in the beginning of the forbearance period. The answer may be to negotiate an arrangement that contemplates a bankruptcy to achieve a mutually acceptable result and avoid the uncertainty of a free-fall filing or issues related to foreclosing on oil and gas properties. With that, I'm going to turn the presentation over to Joe Acosta.
Thanks, Matt. This is Joe Acosta, just making sure everyone can hear me. As Tom had mentioned earlier, I'm a partner in the Bankruptcy and Financial Restructuring Group in the Dallas office of Dorsey. I guess fundamental question is why I'm here. And as Matt explained, the commodities pricing has created a unique environment where exploration and production companies do not have enough money to do their business. With low commodities pricing, there's low cash flow. This is a very capital intensive industry. You need cash flow in order to operate. And then to make it worse, the RBL loans have capped out because the reserve values are now low. And so you have no availability under a credit facility. It's created difficult challenges for a lot of companies. The first slide is just a summary of some of the bankruptcies that have occurred in the last 5 years. This is a cumulative summary between 2015 and 2019. There was over 200. This year alone, we've seen about 20 bankruptcies in the exploration and production company field. And the numbers, pretty startling. The heyday was 2016 when there was 70 bankruptcies. But Rystad Energy, which is an independent energy research company, which collects a lot of data and analytics, estimates that if WTI pricing for oil prices stays around $30, we could see as many as 73 bankruptcies in 2020, and we could see as many as 170 bankruptcies in 2021. They would suggest pricing to be closer to $50 in order to stabilize that industry. But the good news is that they predict that the second quarter of 2020 was the worst quarter for this year. Can I get the next slide, please? What does this mean to secured lenders? Secured lenders as this chart reflects, are extremely affected by E&P restructurings. The left-hand side, the vertical axis shows billions of dollars affected. The red bars are unsecured debt, the yellow bars are secured debt, and the green bars are aggregate debts. And you could see by the end of the second quarter of 2020, we've reached over $135 billion in total debt that has had to be restructured over a 5-year period. And a significant portion of that is secured debt, which secured lenders are primarily interested in. There's So it's going to be a challenge for the lending community on how they handle these E&P restructurings. You turn to the next slide, please. These are the 20 companies that have filed bankruptcy this year. We're involved in a couple of them, either representing the company or some other constituents. The numbers are remarkable. Again, if you just look at the very bottom line, the total amount of debt in that 5-year period is almost $135 billion. And the unsecured debt is close to 75 billion. Secured debt is close to 60 billion. So it is a challenge just to determine how you're going to preserve the value for the lender groups. And it's a challenge that people are having struggles with. Can we go to the next slide, please? So we look at the options. You try to rework the facilities, as Matt had said. You try forbearance agreements, certain bells and whistles. You do, recapitalizations like Buena Vista Energy just announced last week. You do that out of bankruptcy sometimes, and then try exchange offers. And when that fails, you have to go to court. And in court, you're faced with two options: Chapter 7 or Chapter 11. Chapter 7, the easiest way to explain is you turn the keys over to a trustee and you walk away. In Chapter 11, you try to reorganize or you try to liquidate in an orderly fashion. Not lately, but you have a choice between voluntary and involuntary bankruptcy. Sometimes creditors push the company into bankruptcy, and sometimes the company faces its own reality, which is they have to go into bankruptcy. For lenders, they have state law remedies. They can commence litigation, they can ask for receivers, they can impose injunctions. But again, hasn't been too popular of a remedy pursued thus far. Next slide, please, Sean. These are basics. There's nothing terribly new about this. In fact, it's more kind of like a table of contents of what occurs in bankruptcy. On the left-hand side is general process. Everyone's familiar with some of this terminology. Unique contract issues in E&P bankruptcies are just joint operating agreements, leases and royalties, and unique players in oil and gas bankruptcies. On the lender group, you always had lenders in bankruptcies. But you have a lot of new players in this field now. You have different tranches of debt. Whereas in the 80s, it was a traditional bank that loaned money to an E&P company, and they had to deal with one entity when they went into bankruptcy. Now you have different tranches of debt. And it's created some opportunities for junior lenders as well as senior lenders. And it's created some opportunities for E&P companies to reorganize. Other unique players in this field are secured creditors, like mechanics lien claimants. They provide services to E&P companies, and state laws protect them by giving them a lien on properties. Royalty interest owners, generally the landowners who own the land, and lease the land to people that are going to develop the land to drill, to produce oil and gas, are provided liens as well and are protected. Governmental entities as well. You're used to seeing the comptroller, the IRS, the SEC sometimes in big cases, the PBGC. Now we have a new team of state agencies, those that regulate oil and gas, like the Texas Railroad Commission. If you're dealing with offshore entities, you're dealing with the Bureau of Ocean Energy and Management and the Bureau of Safety and Environmental Enforcement. Next slide, please. This is basic 101, and I know we have a sophisticated audience, so I won't touch on most of these bullets, other than to say one change that we've seen recently is really kind of a dramatic shift in where companies file bankruptcy. It's always been the case they can file in the place of domicile. The large companies have in large part favored the Northeast. Well, that has changed in the last 5 years. In Texas, we've seen over $78 billion in debt being restructured in Texas, which has resulted in 106 companies filing bankruptcy here. As compared to Delaware now, we've only seen 34 bankruptcies in the last 5 years, only $26 billion in debt. New York follows with $20 billion in debt and 10 bankruptcies. And then there's smaller players, but that is a significant shift. And people are now relying on Texas law and Texas courts to decide a lot of issues that are uniquely based on Texas law. The next slide, please. Nothing again new here for the audience. There's first day motions which help a company transition into bankruptcy. Usually there's administrative motions, operational motions, use the same bank accounts, pay critical vendors, pay wages. There's some unique motions in oil and gas bankruptcies. That is, the last 2 decades, people have generally filed motions to pay mineral interest owners because they generally file bankruptcy in the middle of a cycle in between receiving revenue. And so you have royalty interest owners and you have working interest owners that haven't been paid. So there's a very famous opinion in Texas, came out of the Tri-Union case in early 2000, where it said that those mineral interest owners deserve to be paid. Nowadays, I haven't seen many bankruptcy cases lately that don't request a motion to pay those parties. There's also motions to pay bonds to stay compliant with state law and operate the wells. On the substantive motions in bankruptcy, when you file, there's lately more of an issue on cash collateral and DIP financing. The pre-petition secured lenders now want to have more of a say on how the debtor uses money. And so there's more heated discussion about that and more litigation in court. Can I get the next slide, please? Overview of the bankruptcy process. Again, basic stuff. There's really I look at it as 5 levels or 5 steps. The debtor after it files, it provides financial disclosure. Then there's an oversight committee appointed. Then there's a process to submit claims and evaluate them. And hopefully the business stabilizes during that process. And with respect to this stage, I would suggest that lenders play a large part in the stabilization of the company. And that occurs during the process when they're negotiating cash collateral or they're negotiating budgets for DIP financing. So they can limit and curb the expenses that they feel that the debtors are overusing. And the last couple of stages are, you file a plan of reorganization, and sometimes you go after avoidance actions, which are things that are not cleaned up during the bankruptcy case. Next slide, please. This is just a checklist. Again, pretty basic stuff. Lenders should be aware of their rights as soon as they feel that a company is reaching a level of distress, because this affords them the right to negotiate prior to bankruptcy as to what the company is going to do inside of bankruptcy. Cash collateral, as everyone knows, is cash or cash proceeds. When oil produces revenue, that's cash collateral. A debtor has to ask a lender for permission to use it. Credit bidding, lender has the right to bid its debt if the debtor decides to sell assets, which often occur. Priming protections, if a debtor decides to get a loan for post-petition financing, it has to provide the pre-petition lenders with adequate protection. Adequate protection and relief from automatic stay, not a hugely popular lender remedy in bankruptcy for oil and gas companies, E&P companies, primarily because the lenders don't want to take over the company. or I haven't seen too many that want to take over the company. And that's for reasons that Mark's going to explain. It's a complicated business that lenders don't like to get into. Lenders, if they're oversecured, are entitled to interest and attorney's fees. With the different tranches of debt, they're entitled to enforce their subordination agreements with the junior tranches. The other remedies are standard. If you believe management is not behaving properly or committing fraud, you can ask to appoint a trustee or convert the case or leave a pre-petition receiver in place. And of course, if you're secured, you're entitled to 100% recovery. If you're fully secured, and that's the value of the assets equal the value of your debt. Other remedies sometimes used is you have guarantees that you can go after. That bankruptcy doesn't affect that. You have people that have signed guarantees. You can exert leverage against them. Next slide, please. Not too many things that are surprising here. Priming liens come into play when the debtor asks for post-petition financing. 364 allows DIP lenders or new lenders to come in and prime existing lenders, but only if they provide adequate protection to the existing lenders. A benchmark, which not all courts and all jurisdictions follow, is that there has to be 20% equity. And if there's 20% equity in the assets that are not encumbered, then that would be considered adequate protection for the pre-petition lenders. So that if someone comes in and provides a new loan to the debtors, it wouldn't wipe out a significant portion of pre-petition lenders. Surcharge is something that occurs in almost every bankruptcy. You have to know going in that the lender's collateral is being used to pay for the reorganization in part. Perfection issues shouldn't be much of an issue. Most lenders know how to perfect their liens on oil and gas properties. One issue that comes up is when there's dueling liens, and that's materialmen's liens and tax liens. They sometimes take priority over lenders' liens and create complications. They allow folks that don't have as much of a stake in the bankruptcy to come in and have a say in the process. And it sometimes creates a fair amount of litigation. Royalty interest owners are nowadays given some liens, they also are given a seat at the table when it comes time to discussing cash collateral issues and budgets. Preference issues for secured lenders is not as much, but if you're under collateralized and you would have received more, preferences are payments that any creditor receives within 90 days through no fault of its own. If you're under collateralized and you would have received more than you would have received in a theoretical Chapter 7, then that constitutes a preference. I haven't seen too much of those, but that's the possibility, and we're all familiar with lender liability issues. Next slide, please. Unique issues facing E&P companies. A lot of what bankruptcy is about, E&P company bankruptcies are the same as any other type of Chapter 11 bankruptcy. But a lot of what these bankruptcies or reorganizations are about is about determining what your state law rights are. And these are unique challenges with E&P companies. And in particular, how do you define what an oil and gas lease is? It may seem intuitive to most folks, but different states treat that property right differently. In Texas, it's a real property interest. In Louisiana, it's controversial. They call it incorporeal removable. And some courts in Louisiana say it's an executory contract. Some courts say it's not an executory contract. And that affects rights of lessees in bankruptcy. It affects the rights of the E&P companies. In Kansas, it's treated more like a contract. When you're dealing with offshore leases, the OCS takes the position that they're true leases, so they're executory contracts. There are other important leases as well, like joint operating agreements. Just real quickly, a joint operating agreement governs the rights between the working interest holders. basically, in a basic level, the working interest owners are the people that make a deal with the landowner to lease them the property so they can develop the land. And in order to govern their rights, you got to enter into a joint operating agreement. Most courts find that joint operating agreements are executory contracts. Farm out agreements are treated uniquely in bankruptcy. The rights of the farmee are protected under safe harbors, which means that it's not property of the bankruptcy estate. As I mentioned before, M&M lien claimants are service providers that are specifically protected. Royalty interest owners are also protected. But fundamentally, E&P bankruptcies suffer from one major thing, which is liquidity. It is a very capital-intensive industry, and they need money. So the solutions that I have seen over the last 5 years are very limited. Either a company arranges something with the secured debt. It's a pre-negotiated plan where there's some type of liquidity that's provided. It's either the senior debt or the junior debt, or the company sells its assets. It's no longer the case that a company, or I haven't seen too many cases where a company drills its way out of bankruptcy or into a successful reorganization. Next slide, please. These are checklists. Every pre-petition lender has to know about any new money coming in, because that new money will impair its collateral. So are there priming liens? Lately, judges have also been asking more about interest rates that are charged for post-petition funding. They're taking more of an interest in that area of law. Generally, a debtor, in order to get secured post-petition funding, has to shop it around and make sure it has the primary terms. And the last slide, please. I'm out of time, but I definitely need you guys to listen to Mark. The 3 bullets are: you have the current trends that I've seen. You have a pre-negotiated plan where there's a restructuring agreement with the primary constituents. Sometimes you have negotiations with the fulcrum debt. The debtors negotiate with the junior lenders that are either out of the money to provide fresh capital, because otherwise the secured lenders will own everything. And covenant defaults are very often, so don't be shocked if they're not filing their quarterly reports. It's part of the process. Still have an opportunity to negotiate with them and try to arrange a plan. With that, I turn everything over to the able hands of Mark Burghardt.
Thanks, Joe, and thanks, Matt. In the few minutes that we have left, I wanted to go through some terminology. If you are in the unfortunate situation where you have to deal with a distressed asset, it should be helpful to understand the nature of the property. So Joe had mentioned this, but the basic unit that you're going to deal with in an oil and gas asset is going to be a lease. There are some fee interests that you'll encounter, but those are pretty rare. For the most part, you have a company that's come in and taken or acquired a lease in the underlying mineral interest. Those leases are typically issued for fixed terms. You'll see 3, 5, or 10 years. 10-year primary fixed terms are somewhat rare these days, unless you're dealing with a government agency. Upon the expiration of that primary term, the initial fixed term, the lease will continue in effect for so long thereafter as you have production under the lease. Most of the time, the term of art is that it's production in paying quantities, and that's known as the secondary term. I'll discuss that again here in a minute and how you make that determination. The production associated with a lease can either be direct or what I call associated production. So production from a well that is occurring off of the lease, but that is allocated to that lease through a variety of mechanisms, really pooling agreements, where you take several different leases and you combine them together and you pool those together into a common unit and say the production from this area is coming from these leases. A communitization agreement and unitization are really larger concepts. A communitization agreement is a pooling, and it's a term specific to federal and Indian leases. That's the term they use for a pooling agreement. A unit, as I'll discuss at the end, is a much larger unit of oil and gas leases that can consist of a larger geographical area where they're operated for the most part together. So at the end of the primary term, if there's no production, the lease doesn't necessarily expire. There are some savings provisions in most leases. If production had been established before, but the lease or that production stops, you're oftentimes given a grace period of 30, 60, or 90 days to restart production. Some leases have a shut-in provision that allows you to shut in a well. That means to cease the production. The key that a lot of people don't understand is that these shut-in provisions are almost always related to gas, and they require that you can only shut in the well for lack of a market or lack of a reasonable market. It essentially, if you don't have somewhere to transport that gas must be transported by pipeline. So this is a clause that allows you to pay a sum instead of producing that gas. There's also continuous drilling. So if you're drilling a well at the end of the primary term, most leases will allow you to keep drilling subsequent wells on the lease and continue the lease that way. A term that you should be aware of is a pew clause. So if your lease doesn't have a pew clause and it covers a large geographical area, production or associated production for any of that area will hold the entire lease. Some leases contain a pew clause that require production to a certain geographical area or mandate that the lease be released below the deepest depth drilled. So pew clauses come in horizontal and vertical pew clauses. Vertical are just geographical area, and the horizontal pew clause is really something that operates at a certain depth. A lot of those pew clauses, especially the horizontal pew clauses, operate at one point in time at the end of the primary term. They're not a continuing obligation, but they're something certainly to be aware of. Some of the other agreements that you may encounter in the oil and gas asset are the unit agreement, which I had mentioned, which covers a much larger geographical area, several square miles oftentimes. Communitization agreement, pooling agreement, I'd mentioned that before. I know Joe touched on a joint operating agreement. There are considerations. A joint operating agreement is an agreement between operators of really the lessee of various oil and gas leases or various interests to define their obligations. And then a farm out agreement is really something that where a lessee doesn't want to develop the acreage, they will farm out that interest to a third party who will come in and drill a well and earn acreage in that interest. And so there can be continuing obligations with that. Next slide. So one of the questions in evaluating the asset is trying to figure out where are you at in the life cycle of an asset. Are you at the beginning or are you on the more mature end of the asset? To determine whether an asset is more mature, you can look to things to see if there's an active drilling program. Is drilling required to hold those leases? Are you essentially in the primary term and do you have to drill to maintain that lease or will your lease expire? If the answer to those are no, and the locations have been drilled and this is simply a producing field, really all that's required is to maintain that production and paying quantities. That sounds easy enough, but there are some considerations that a lot of the unconventional wells that are being drilled right now have a sharp decline curve. And so the life of that well may not be that long. So they require additional drilling to maintain them. If you're in a relatively new field and the leases are in their primary term and will expire without operations or production, then you've really got some options if the asset is not actively being developed, you've got to ask the question of how do you save these leases? This question really goes to if an oil and gas company is distressed and their assets are headed into bankruptcy and you've got to protect those assets, you really got to maintain that lease unit itself. So for fee leases, which will probably make up a majority of the asset in a lot of states, they're just contracts. You can really contract around that, and you'll see that a lot of the operators will go to the fee owner, the underlying mineral interest owner, and try and negotiate an extension. You can pay money, get that extension, and then record it in your lease. The primary term really will be extended. The problem is that those extensions and that process really don't apply for the most part to state leases, definitely not to federal leases, and under very certain circumstances to Indian leases. You'll probably be in a situation where you have to renegotiate the lease or the development agreement for an Indian lease. You also have the option under probably any of those types of leases to drill and to commence drilling operations and to engage in a continuous drilling program. That doesn't always mean drilling a well and producing it. It can be simple things like I've listed here: staking a well, building a road, surveying the location, anything that's in preparation and furthers the drilling of a well. The question of whether you have continuous drilling operations to save a lease is a question of state law. So there's pretty good case law in the variety of states where your assets may be located. Next slide, please. So the fundamental problem with an oil and gas asset is trying to evaluate whether your lease is still valid. The question of whether a lease is valid, these are very dynamic assets, and that question is really a question of fact. They are, as I like to explain to a lot of parties, latent defects. You're not going to get a notice, with the exception of a federal lease, you're not going to get a notice that the lease is expired. The lease is, if it's in its primary term, will still be valid, but once that primary term expires, it requires continuous production or continuous operations. If an event had happened where that production had ceased for a sufficient period of time, or the continuous operations didn't fit in the window that you have between drilling one well and drilling another well, that lease could expire by operation of law. And production of that lease without some sort of confirmation from the owner will not save that lease. So you could have a situation where a lease is produced for 3 years after a sufficient gap in production. That subsequent production may not save that lease. That's a tough road and something that's pretty tough to prove. The claim that a lease has expired from the landowner is something that can be brought several years later. It often doesn't come up, given that the landowners are individuals and this analysis is pretty complicated, until you try and turn around and sell that asset. And a purchaser will go back and look at production records and really find that there may be a gap that may have invalidated your lease. It's also possible that that situation will be disclosed by a rival company who is coming in to top lease and try and exploit that weakness. I have seen in the past few years some additional plaintiffs firms that go out and get collectives of owners and try and challenge that there wasn't sufficient production to meet that paying quantities determination. For fee leases, the cure is really pretty simple. Companies will go out and pay some money like you did for an extension and get a ratification that says, as of right now, the lease is valid and all prior violations of lease terms have been cured. So that's a mechanism. Federal leases in this context are much easier. So once a federal lease starts producing, it is converted to what the federal government calls a producing non-terminable status. And that means that that lease, even if production ceases, cannot terminate until the federal government gives what is known as a 60-day notice. And that notice will tell you, as the operator, that you need to come in and produce the well, or your lease will terminate. Those 60-day notices are pretty rare. The federal government doesn't issue those very often, so it's not usually a pretty serious concern. Once you have established production on a federal lease, that lease will continue into the future for long periods of time. I had mentioned a unit before, and I wanted to touch on that. Some people will encounter a unit and leases that have been are included in the geographical area of a unit and say that's the end of the analysis. For a federal lease, that may be true, but for a fee lease, a state lease, or an Indian lease, that's not always true. And you're going to have to satisfy continuous development provisions and make sure that you're looking at that lease and its terms on a lease-by-lease basis. So beware of the unit and the geographical area. So final slide. Some of the other considerations that have been touched on that I'm going to expand on just a little bit in the brief time we have is whether the borrower is an operator or a non-operator. If the borrower is an operator, there's a whole host of problems that come with being an operator. Not only do you have to operate the well and continue production and everything, but you're going to have to get approval from the government to do that. If your area or lease is a state or federal lease or involves state or federal leases, then you're going to have to get approval from both the state agency and the BLM. If you're an operator, you may get a notice to plug and abandon a well that triggers a period of time under the state or federal regulations or the lease terms within which you have to bring that well back online. So there's those obligations. One of the really big considerations, if you're the operator, is bonding. So if you're taking over an oil and gas asset, the bonding has historically been pretty cheap. You could have a statewide bond for $25,000 that covered all of your operations if you had one well or 1,000 wells. Now, state agencies and the federal government have gotten a little more wise to that and are drastically increasing that bonding liability or that bonding coverage. And you're seeing situations where the bonding liability for to plug and abandon the well exceeds or drastically exceeds the value of the asset. So you have an asset that may be producing at some level and may have reserves, but it's not worth anything because the P&A, the plugging in and abandoning liability and the bonding liability is much greater. Another consideration if you're the operator is that administrative proceedings really should be stayed. That doesn't come news. That's not news to any bankruptcy attorney, but we've encountered a lot of situations lately where state agencies have tried to move ahead with forced pooling or telling you that you have to plug and abandon a well and have not really stayed with the automatic stay. The other and the final thing that I'll mention here, I guess, is executory contracts. You need to consider what happens if you reject a JOA, especially a unit JOA. There may be unintended consequences that you really need to consider. There are some advantages to rejecting executory contracts like a net profits interest, other payment obligations, midstream contracts, but they may have consequences that the parties don't consider. Evaluating these executory contracts is a question of state law, and it's a really complicated analysis, and so you need to evaluate the asset on a case-by-case basis. The whole point of my portion of this is to say that these are really complicated assets, and you really need to ensure that you understand the nature of the asset so that when the company that's operating it or owning it goes into bankruptcy or restructuring, they don't start hemorrhaging leases and lose a lot of the value of the asset itself. So thanks for your time today. That's all I have.